What's going on social media? I wanted to make a quick video talking about the recent changes in the Fed's policy, how that's affected interest rates, and what that means for housing affordability. So let's jump in. So in November of 2021, just last year, beginning of November, the Fed announced at their committee meeting that they were going to begin reducing the monthly purchases of assets and that they were going to begin raising the target for their federal funds rate. And so they actually started putting this into practice in December. And as you can see by this chart, right about that time, rates really took off. This is just an example of the 10-year and of the 30-year mortgage rate. And so why are they doing this? They're doing this because they are trying to handle an issue with wages right now. Somebody after this press conference in early May asked him a couple questions, including one about unemployment. And so he gave kind of a double answer. He said an argument that would support unemployment going up. He also gave an argument that would support unemployment going down. And for the one going up, he says that they're expecting there to be some additional participation in the labor force, and that would keep unemployment up. The way that works is as people are returning to the labor force, it's presumed that they don't yet have a job right away, and so they're going to be unemployed for a certain amount of time until they find a job. And so there's going to increase or kind of support to the upside the unemployment rate. And so he also gave an argument for how the unemployment rate could go down, namely with less supportive fiscal and monetary policies, how it could slow job creation, and as a result, unemployment would go down. And again, they're trying to do this because they're looking at a huge issue they're trying to handle within the labor market, and that's wages. Wages right now are running high. Apparently, they're the highest they've been in quite some time. And so the reason this is happening is an imbalance between the supply and demand of labor in the market. And so there's a tremendous amount of demand for labor. There's 1.9 open jobs for every unemployed person, and there's a very, very, very subdued amount of labor in the labor market. And so with that offset of supply and demand, wages have been on the rise. And so what they're expecting is their policies, namely higher rates, is going to heal the labor market or help heal the labor market, and it's going to bring wage inflation back down. It's going to moderate wage inflation. Um, why do they care about inflation? They are congressionally mandated to worry about two things. They have to worry about maximum employment and price stability. And so maximum employment is nearly taken care of. Unemployment is back at nearly what it was before the pandemic, before the shutdown in early 2020. We do have a smaller labor force. However, the percentage of unemployment is similar to what it was before. And so we're near accomplishing maximum employment again. But price stability with wages rising is an issue, and they're trying to address that. Now, I am a broker, so I'm explaining how all this affects real estate. This makes an impact because wages obviously directly impacts income, and income directly impacts housing affordability. So let's take a look at affordability. This is a chart. It's from NAR, the National Association of Realtors, and this is their Housing Affordability Index. What this looks at is whether a typical family can afford a mortgage on a typical purchase of a home. Typical is defined by them as a single family home at the median price. So a median price home with 20% down as for a mortgage. If a typical income can handle that, you are at exactly 100. 100 again means that your income is exactly enough to cover a mortgage of a typical median price single family home. Anything above 100 means you have more than enough. And so all of this is median based, so it's not going to apply to every buyer. However, here it is. So when rates took a dip in the beginning of 2021, when they were at their absolute lowest, this is in January of 2021, housing affordability went through the roof. This is because with lower interest rates, the monthly payment to service the debt that you're borrowing was lower than what it would have been at a higher rate. And so affordability spiked. But as rates kind of went lateral and stay flatline all throughout 2021, but median prices continued to rise, affordability started to come down a little bit. And then after the announcement of the Fed taper and the commencement of it in December of 2021, again, when rates took off, you can see housing affordability just completely fell off a cliff. So to give a little bit of context, this is a chart of what the housing affordability index looked like in the bubble that led up to the subprime mortgage crash of the late 2000s. The most unaffordable that it had become, the housing affordability index dropped to 100.5. That was when it was, by this metric, the least affordable. All right. So what does all this mean? I made a video the other day talking about how I believe the market had peaked, and I was talking about in terms of the speed at which things are going under contract. And so I wanted to tie that into how this works. So with inventory being still at unsustainably low levels, this is the United States, but it's definitely applicable even more so to Florida. As inventory continues to stay low as what it is, if the Fed continues to hold the policy to be less supportive and interest rates either stay flat with where they're at or they continue, God forbid, to go even higher, then that's going to continue to diminish the housing affordability index, which means that housing is going to become increasingly more unaffordable unless we get a massive amount of supply back on, which is going to bring down median pricing and make up for the rise in rates. Housing affordability is going to continue to diminish, and we are going to continue to have a situation with unaffordable housing moving forward. So if you are a buyer and you want a little bit of help navigating the waters in all of this, or if you're a seller and you're looking to take advantage of some historically low inventory, please feel free to reach out and I'd be happy to help. My name is Marvin Mora. I am a broker associate down here in Miami, Florida. You guys stay safe. Take care. Bye bye.